So yeah, this question came in through YouTube. Um, and I was a little bitter about this because me and Brett had a laugh about it. But he says, "Hi, hey Brennan," in brackets, Killer B number 2. That's what I'm a little bitter about. I think that I'm Killer B number 1. But Ryan says Brett and Brennan. You know, Brennan and Brett doesn't roll off the tongue. Brett Brennan, it rolls off the tongue. So I get it. But
And that's
anyways,
why. That's the only reason why I say his name first, right?
exactly. Number 1 right here.
B
Number 1.
squared.
Yeah. So anyways, he says, I'd appreciate getting your thoughts on Maple Leaf Foods. It always seems to get in the penalty box regarding stock performance. Always appreciate your analysis. Well, I'm glad that you always appreciate my analysis. So hopefully you appreciate this one. So looking here, Maple Leaf Foods Inc. MFI on the TSX, currently trading at a price of around $23.10, a $2.8 billion market cap, and a dividend yield of about 3.8%. So the company produces packaged food products globally, including prepared meats, ready to cook and ready to serve meals, snack kits, fresh pork and poultry, and plant protein products. So since 2018, the stock really hasn't done too much. The last time we covered Maple Leaf on the podcast was as a dog of the week in August of 2022, after the stock was down around 17% after releasing week Q2 2022 results. And Aaron, who did the segment at that time, noted that analyst estimates for 2023, so the year that they just reported, were approximately $1.10 adjusted earnings per share. But as Aaron stressed on the podcast, we should take this estimate from analysts very, very cautiously. So looking at the financial results here, revenue in Q4 of 2023 was up around 0.6%, so basically flat, but to 1.19 billion. And this was primarily driven by the company's meat protein group sales, which were up 0.8%. Adjusted EBITDA was up over 100% to 120.2 million, with the adjusted EBITDA margin increasing to 10.4% in Q4 from just 4.7% in Q4 of 2022. And adjusted EPS was 8 cents per share, up from a loss of 28 cents in Q4 of 2022. And note that in 2022, analysts, were anticipating adjusted EPS of over $1 in fiscal year of 2023. Well, that was pretty far off, given the company only did 9 cents adjusted per share in the year. So right now, Maple Leaf currently has net debt of about 1.75 billion and a trailing net debt to EBITDA multiple of 4.1 times. And for context, the company's debt is primarily variable rate, with a weighted average interest rate of 8.2% as of December 31st of 2023. But about 20% of the floating rate debt has been fixed at 4.7%. With an interest rate swap. So that is something to note. And management also noted in their press release and on the conference call that they are now currently focused on deleveraging. So quickly looking at the valuations, the stock trades at over 200 times trailing adjusted earnings, with an EV to EBITDA of approximately 11 times and a price to cash flow multiple of approximately 16 times. Now, looking at the company's 2024 guidance, management anticipates low to mid-single digit revenue growth and is looking for adjusted EBITDA margin expansion over 2023. And this is supposed to be led by the normalization of the meat protein group's adjusted EBITDA margins to 14 to 16%, where they did, again, about 10% in fiscal year 2023. And they believe that this will be kind of led by the pork market, which has had some difficulties here recently. So the company has grown the dividend quite aggressively over the years, from about 4 cents per quarter in 2011, and it's now up to 22 cents per quarter in 2024. Now, the dividend currently does not look sustainable given the company's depressed profitability. However, I'm not going to declare that the dividend will be cut, as in fact, the business just increased the last dividend by 4.8%. But we really need the company to get back into meaningful earnings before we have confidence, as even if we annualize the Q4 adjusted EPS of 8 cents, we are still left with a forward payout of about 275%. And again, that is looking or just using the Q4 adjusted EPS, and we're annualizing it. So, really, we would really like to see profitability improve in 2024 and for the dividend to become more sustainable. I give enough companies a hard time when they issue shares like it's their day job. So here you can see Maple Leaf share count has actually been quite steady and declining since 2016, which is a good thing to see. So I will give them props there. Now, moving on. So to conclude, at this point, Maple Leaf is really a turnaround story, in my opinion. They're coming off of a difficult post-pandemic period by a dislocated pork market, inflation, disrupted supply chains, and consumers increasingly under stress. And management is looking for the pork market to normalize in 2024. But this is very difficult to predict. I saw an article from an organization out of Alberta. They were saying that the outlook is actually not that great for 2024. Again, it's a commodity; it's tough to tell. But margins are beginning to essentially recover, and management does expect this to continue with restored health of supply chain as well as increased pricing to catch up to inflation. And like I previously said, management is focused on paying down debt and to be more disciplined on capex spending in 2024. So it might be a little bit of a cleanup year we see here. So Aaron mentioned back in 2022 that the company was finishing its London poultry and bacon center, which management believes will further be accretive to adjusted EBITDA in 2024. And long term, Maple Leaf has grown its revenue with a compound annual growth rate of about 5% from 2014 to 2023, and it's guiding for similar growth in 2024. The company currently trades at, like I said, 16 times cash flow and 12 times EBITDA and pays out a nice yield, although a very high payout ratio at this point. And the leverage is quite elevated at over 4 times net debt to EBITDA. So, overall, I think that Maple Leaf is a good company, and someone could invest with maybe a contrarian approach if they believe the company is in fact on the other side of its headwinds, which will allow it to increase its profitability. However, at this point, I think it's really a show me story of replicating the margins in Q4 of 2023, further paying down its debt, which is kind of above our comfortable range, and getting the payout ratio in a reasonable bound by, again, increasing those margins. So that's really what we're trying to see here going into 2024, is to see those margins continue to hopefully increase, which management is expecting right now.
Yeah, I'd say there's nothing worse than a dislocated pork market, is there? That's one of the things that I dread when I think of what could go on in a year, have a dislocated pork market. No, but Maple Leaf's food seems to be continually. Pardon? Keeps me up at night. It does. If anything does, it's that. Maple Leaf Foods to me seems to be continually a next year story. Every time I look at it, analysts expect a huge jump in profitability in the coming year, but then that doesn't materialize and the growth story is pushed out for another year. I like the products, but I think Brennan said, so show me the story. So show me the money, show me the profitability at this point. Yeah. And bring down that debt a little, and then it could get interesting.
So Brennan's declaring that the dividend will be cut?
No.
Yep, he declared it. I heard him. He said it.
Exactly.
I did not say that. Quote, they just increased Brennan. It, so I can't see that they'll.
No, but I don't know if they're basing the payout ratio on adjusted earnings or where, but like obviously, when you're looking at a payout ratio, any payout ratio that's above 100%, you've got to start to wonder where the sustainability is, right? I mean, either they're basing it off of free cash flow and free cash flow is better, or they're just looking at growing into that high payout ratio. But it's you can't say that the dividend's sustainable when you're paying out more than you're producing.
And I caught the tail end. They're buying back shares. They have over the last 10 years. They've reduced the share count, right?
Yep, they've been reducing the share count.
But they have a significant debt position. So
yeah.
So I mean, it's where you're allocating capital. It's nice to reduce the share count, but the debt levels are high right now. So
yeah. And high interest rate, 8.2%, and
it's
something
shrinking cash flow. Obviously,
I brought up the interest rate swap. Well, I mean, it would be good to see when that actually comes off. When is the I think it's about 18% of their debts fixed with that swap. When's that going to come off? So, that'd be another thing that I'd have to look. And I should have done for the listeners, but I didn't. I apologize. Don't hate me.
You do it for clients though, wouldn't you? That's what you're saying, right?
Yes.
Yeah. Awesome.